The good news is that you don't have to learn how to prepare the cash flow statement from scratch because, as managers, it will be more relevant to you to be able to understand the cash flow statement, interpret it rather than preparing it. So, for the cash flow statement, in order to prepare it, we have to do a lot of calculations, which we won't do in this topic because you're not accounting students. But it's worth knowing a little bit about how these calculations are done so that you can interpret it better. So, the cash flow statement is prepared by deducing cash flows from income statement and the balance sheet. So, by converting the accruals to cash. Identifying and showing the cash receipts and payments of operating activities by the type is called the direct method of preparing the cash flow statement. But there's also an indirect method of preparing the cash flow statement. So, with the indirect method, the accounting standards require companies to perform a reconciliation of profit or loss after tax with the cash flows from operating activities. You need to remember that depreciation, bad and doubtful debts, gains and losses from disposal of non current assets, writing off damaged inventory, and revaluation of assets are all non cash expenses which do not go into the cash flow statement. So that's all you really need to know about cash flow statement. You need to know how it looks like. You need to know the different segments or categories of activities within the cash flow statement and the sort of transactions that each section includes. You also need to know that there is the direct method and the indirect method of preparing the cash flow statement. And that's it. We won't really go into any more depth than that with the cash flow statement. So, in conclusion, remember cash is king. The cash flow statement shows the inflows and outflows of cash, and these relate to three different activities as we talked about: operating activities, which include receipts from customers, payments to suppliers and employees, interest payments, and income tax payment. So, regular or day to day activities of the business. These are relevant to the main activities of the business, main operations of the business. Second is the investing activities, which include purchases of non current assets, so purchase of property, plant, and equipment, or proceeds from the sale of property, plant, and equipment. Interest received and dividends received are also inflows from investing activities. And the third section is financing activities, which includes proceeds from borrowings or payment of borrowings or loans, proceeds from the issue of shares, or payments of dividends to the owners. So remember, profit after tax is the profit calculated on accrual basis. And with cash basis, we take that profit after cash and reconcile it to the cash flows from operating activities. So, quick quiz before we end this very short lecture. The purpose of the statement of cash flows is to provide information on it's the cash inflows and outflows. Cash flow statement only includes information on cash transactions, so cash inflows and outflows. Profits or losses or the net worth of the business are all based on the accrual basis. The second question, all of the following are operating cash flows except dividends paid to shareholders, because dividends paid to shareholders are financing activities of the business. So any money paid to or received from shareholders is part of financing activity of the business. And the third question, cash flows from operating activities are concerned with the trading and service operations of the business, because operating activities refer to the main trading or operations of the business. So because this was such a short lecture, and because we don't really have any practice questions for cash flows because we don't need any, I thought it would be worth it to include a practice question on the income statement and balance sheet so that you get some extra practice. So let's have a look at this business, DD's Domain, a sole trader, and their accounts for the year ending 30th June 2018. So using this information below, you've been asked to prepare an income statement and a balance sheet for this business. So even before you watch me go through the solution, maybe pause the video and have a go at this yourself, and then check your answer. So let's categorize all of these accounts into the various categories. So assets, liabilities, equity, income, and expenses accounts. So for the income statement, we need incomes minus the expenses. And for the balance sheet, we need the other three, so assets, liabilities, and owner's equity. So let's have a look at each and see if we know what each account is. So cash is an asset. Sales and income. Insurance expense, it already says it's an expense account. Accounts payable is an obligation to pay money to someone, maybe a supplier from whom you have purchased on credit, or some other account, some other expense account that is still owing. So it's a liability. So capital opening balance, capital is an equity account, so owner's equity. Motor vehicle is a non-current asset, so it's an asset account. Depreciation expense. So with depreciation, remember there are two accounts. One is an expense account, which will be called depreciation expense, and the other is a contra asset account, which is accumulated depreciation. This one is depreciation expense, so it's an expense account. Repairs expense, says expense, so it's an expense account. Inventory is an asset account, it's a current asset. Motor vehicle expenses. So motor vehicle expenses may be the running expenses like fuel costs. So that's an expense account. Rent expense, again, it's very obvious, it's an expense account. Bank loan. Loan is a liability. This is a non-current liability account, so liability. Cost of goods sold, that's an expense account. Interest expense, very obvious, it's an expense account. Drawings is a negative equity account. Remember, drawings are recorded when the owner withdraws some form of cash or other asset from the business for their personal use. So it's an owner's equity account, but it reduces owner's equity. Accounts receivable, that's an asset account, a current asset. Accounts receivable is when you've sold on credit and are expecting money back. And accumulated depreciation, as I said a while ago, this is a contra asset account. So we'll categorize that as an asset, but remember it's contra asset, so this will be a reduction of asset. It's a negative asset. So now that we know all this, let's prepare the income statement first. For the income statement, we will need the incomes and expenses. So from this classification, just pick the I and E figures because these are the only ones you will need for the income statement. So I've isolated the I and E figures, the income and expenses figures, and that's all we need for the income statement. So for the income statement, we start by writing the name of the business, writing the name of the statement, so income statement, or we can write statement of financial performance, and writing the date in this format for the year ended 30th June 2018. So first thing we list would be any incomes. So looking at all of these income and expenses accounts, there's only one income, which is the sales or sales revenue. So we write sales revenue and the amount is $100,000. From sales revenue, we directly deduct the cost of goods sold, minus $60,000. So see how I'm crossing off every item as I put them into the statement? This may be a good process to follow just for yourself, just to ensure that you're not missing anything out. So coming back to the income statement, we have the sales revenue minus cost of goods sold. See how we have put this in brackets. This gives us the gross profit, which is 40,000, minus operating expenses, which would include all of the other expenses. So depreciation 4,000, insurance expense 3,000, motor vehicle expenses 8,000, rent expenses 10,000, and repairs expenses 1,000. The total of all of these operating expenses, if you add all of these up, that gives us 26,000. Sorry, the alignment is not very nice. So the total of all of these expenses, 26,000, which is also shown in brackets because this total will be deducted from the gross profit. So that gives us the operating profit. We haven't included interest expense yet because interest is not an operating expense, it's a non-operating expense. So then we deduct interest expense, 2,000. That gives us the net profit of 12,000. So 14,000 minus 2,000, 12,000. That's the net profit or profit for the year. And just going back to these individual accounts that we have crossed off all of these, which means we haven't really missed anything. So that looks good. Now let's go and look at the balance sheet. We'll definitely need the net profit figure for the balance sheet. And also for the balance sheet, from the previous slide, the asset and liabilities and owner's equity accounts, all of those will be needed. So I've copied all the asset, liability, and owner's equity accounts here. So here's an A star for accumulated depreciation because remember that's a contra asset account, so it's a negative balance. And star beside the drawings owner's equity because that's also a negative. Now, assets and liabilities, remember there is a further classification to that, current and non-current assets. So let's just quickly classify them further into current and non-current. So C for current and C for non-current. So remember, current assets are any assets that are already cash or can be converted to cash in 12 months' time, in less than 12 months. Any other assets would be non-current. And for liabilities, current liabilities are those liabilities that you have an obligation to repay in less than 12 months. Any other liability would be a non-current liability. So cash, it's already cash, so it's a current asset. Accounts payable, it's a liability, and it's a current liability because you have to repay it in less than 12 months, usually a very short period of time. Capital is owner's equity, so no further classification for that. Motor vehicle is an asset and it's a non-current asset because the business is unlikely to convert this to cash in less than 12 months. Inventory is the main trading asset for a business, so that's definitely current asset. Bank loan always refers to a long-term loan unless otherwise specified, so it's a non-current liability. Drawings is owner's equity, so no classification anymore. Accounts receivable is a current asset because the business expects to receive this in less than 12 months. And accumulated depreciation is depreciation of the non-current asset. So it's a contra asset, but it's non-current asset. Remember the profit that we calculated in the previous slide in the income statement? That's the link between the two statements. So that will also be included in the owner's equity section when you draw up the balance sheet. So even before we draw it up, let's quickly check that we're doing it correctly. So let's add up all of the assets because we have them. So the assets, 10,000 cash, plus we have motor vehicle, 24,000. We have inventory 16,000 plus accounts receivable 18,000 minus the accumulated depreciation, which is a contra asset, 8,000. So adding all of these up, deducting the accumulated depreciation, gives us 60,000. Let's calculate the total for liabilities. So liabilities, we have accounts payable 12,000 and we have a bank loan worth 20,000. So 12,000 plus 20,000, that's 32,000. Assets minus liabilities, that is net assets, would be 28,000. So 60,000 assets minus 32,000 liabilities, net assets equal to 28,000. And next step would be looking at the owner's equity and calculating the total for that. So owner's equity, we take the opening balance of capital, 26,000, plus the profit that we calculated, 12,000, minus the drawings of 10,000. That gives us 28,000, which is equal to the net assets. So let's prepare the statement of financial position or balance sheet. Remember, we start by writing the name of the business, the name of the statement, and the date in this format. So we start with the asset section. Current assets, we had cash 10,000, accounts receivable 18,000, inventory 16,000, total 44,000 current assets. Then we list the non-current assets. There was only one non-current asset, a motor vehicle, worth 24,000, minus accumulated depreciation of 8,000. So 24,000 minus 8,000, that gives us 16,000. We add the current asset total with the non-current assets total, and the total assets would be 60,000. So 44,000 plus 16,000 gives us 60,000. Then we list the liabilities, again classified into current and non-current. So current liabilities had accounts payable of 12,000, just one current liability, and also one non-current liability, a bank loan of 20,000. So add the current and non-current liability together, 32,000 total liability. So then we can calculate net assets by deducting the total liabilities from the total assets. So 60,000 minus 32,000, net assets is 28,000. Finally, the equity section, starting with the opening equity or opening capital, 26,000, plus the profit, add the profit from the income statement, 12,000, minus drawings, which are withdrawals by the owners, 10,000 were the drawings. So 26,000 plus 12,000 minus 10,000 gives us 28,000, which is equal to the net assets. So net assets equal to total equity means our accounting equation balances. We have already checked it in the previous slide, but the checking that we did in the previous slide was optional. You don't really need to do that unless you want to. This is the proper statement. So that's the end of our very short week 6 lecture. Please remember that assignment part 1 is already on Flow. There is an announcement explaining everything. Please read the instructions very carefully because you will need to complete the assignment in the form of a Flow quiz. So it's all there on Flow. The instructions are very clear, but if you have any questions at all, please feel free to send me an email. And I'll be back next week, so I'll see you soon.